Hey traders, doing an update on some global macro markets. Hopefully you can see this all right. Sometimes when I travel, this symbols get really small here on Thinkorswim. But I want to talk just about a couple calls. I covered Bitcoin in our room a little bit earlier today. Here's the futures. So from a hedging standpoint, I'm very light on my hedge. I was short 3 contracts, so it doesn't really matter. Some traders are bigger than others, but point is that I took down 2/3 of my short position into these lows this morning. That was some first support. The closing lows is 7,600, and then there's an intra closing low at 70.60 before you have the intraday low of 58.80. So the market intermediate term structure is still that of a downtrend. We are making lower highs. What's going to change that first is a bounce above this pivot high right here at 9,200 basically. But really, to kind of change this whole structure that's been in place since futures started, is you got to get above this triple top up here. It's 11 3/4. That's a whole area. Call it 11,800. You see the bands are right here. That's going to really change the market. But so at the same time, I think a small short is okay if you're using that for hedging purposes. Some of you are short the cash market or shorting some other things, and that's okay. I think you want to have a little bit of a short on from the intermediate term if we do make one more push into these lows, and that's where I would cover and go. Actually, I'd cover and go long because I'd get more aggressively long into these lows. But if we don't move lower and we do take out this pivot, I'm actually going to probably take off this last short and just ride my longs on in the spot market, in the cash market, meaning stay long my BTC that I actually own in my wallet. And so I'd take off that futures short and just get flat from a hedging standpoint if we take out that high. So that's what I'm watching on the up. And then from there, if that were to happen, maybe I reshort just one contract in this example at 10,000, but then really the place to be hedged up again is again at this major level up here. Now, when I look at the overall market, we've had some good calls, really good calls on Apple and S&Ps, for example. So big picture, we talked about, obviously we were bullish all of last year. We've been bullish since the election. Because growth started to accelerate again. It just is what it is. When you track GDP on the sine curve, the cycle turned up. So when that happens, growth's accelerating. You want to be long high beta. You want to be long tech. But the U.S. growth market was completely fine. So we were bullish all of last year. The market got very vertical here into the beginning of the year to just levels that was stupid overbought. So there was no way you could be adding to big positions up here. This was areas to take profit. And then we all know what happened in January, February. We liked the market down here. We still like the market down here. And I'm a buyer, I said yesterday, in S&Ps between 2,500 and around these lows, this double bottom here. It's like 2,540. The last call we made was to come out of some of your longs and or go short up here at the top of the intermediate term risk range. That was a great call. You could see that I was putting my money where our mouth is. We were at a long Apple when we got down to these lows. I sold 150 puts, meaning which is bullish when we were down at these levels. The market rallies. You sell calls. We sold calls up here at 180, 182.5. The market pulled back. I covered those calls. I was light in my overall core position. I bought puts up here also at 175. The market's rolled into that strike and through it. So I've taken profit on my puts. And from here, if the market bounces back, that's fine. I'll rebuy my puts at much cheaper levels after making money and taking profit. If we don't bounce and we collapse further, and Apple's a great proxy for the NASDAQ, obviously, because it makes up most of the NASDAQ. If we drop further, then I'm actually going to add back to my stock position and start selling puts again. Just the same thing that we did down here. So we'll be buyers again at 2,500. The levels we're at right now, I see that as a short covering opportunity, but I haven't gotten long yet. The next push down is where I look to get long. And then I just wanted to say one other thing, big picture. Gold has had a big move. Gold is trading much better here this week. And I think overall that commodities have been very dormant for the last several years. I mean, coming out of 2000, the commodities really boomed. China was doing well. And so commodities peaked with the business cycle in 2011, and it's been in a bear market, multi-year bear market since 2015, where it bottomed, but didn't change direction until 2016. So we had our initial kind of end of the bear market since 2011, and I'm using gold as a proxy here, but all commodities basically peaked. If you look at CRB index, it's the same thing. But what's really going to create this next leg up and some really big momentum and inflows and really move gold into the limelight is we got to get above 13 3/4. 1378, 1375, you could even say 1400 is where you got to close on some daily, weekly, monthly closes. But I think we got a good shot at getting that. So I've been a buyer in front of 1300, 1315. It's had a great week this week. It trades really well. And so I'll do some more videos on this, but I think we're going to have to watch gold. If gold starts to break out, it's going to be tough for stocks to go down and bonds to go down and the dollar go down. And you're probably capital is going to have to shift somewhere. If stocks come off and let's say we break these big picture levels on the weekly level down here in S&Ps, and you roll into a bear market in stocks, well, bonds are already in a bear market. So can stocks and bonds go down? Absolutely. But if that happens, the capital has to go somewhere, and I think it's going to go into commodities if that takes place. I think at some point you're going to get a lot of fits in the bond market. It's going to be spastic, or it's just going to be you're going to have a lot of reactionary moves in bonds that as soon as stocks get sold off enough, there's going to be that quick, faster money that moves into the so-called flight to quality trade, and you're going to see bonds rally. But even as stocks came off here on this most recent move, bonds rallied, but then they came right back off. So bonds did rally, but then the bid fades and the market just tails off. So I expect that if we really have some big down moves in stocks, you are going to see the bond market kind of spike up. But I don't expect those rallies to really last since bonds are in a long-term bear market now. So that's just something to look at. I think commodities are poised here, global macro, to do really well. And I think we're going to see potentially maybe stocks roll over and the bond market, which is already rolled over. But we'll see. I don't want to make that call that stocks are bearish until we start breaking pie and we break these lows we made. We're still in an uptrend longer term. But that is something that I start to seeing rotating, is you can see how well gold is trading. And then it may be a situation too where I'm watching the dollar. I've been bullish the dollar, but if for some reason the euro gets above 125 and starts to move towards 130, we could see dollar weakness, which is going to push gold up even more. But again, if you have stocks and bonds selling off, where is the capital going to go? I think it'll be real demand for commodities, and if commodities rally, it's not necessarily just going to be because the dollar is weak. So we'll see. I still don't really see how we can have stocks go down, bonds go down, the dollar go down. I mean, if money is selling assets, how does the dollar going to absolutely collapse like everyone keeps calling for? I don't really see it. Unless the capital just goes into the commodities and it doesn't go into the dollar. Oh, we'll see. We'll just follow the model and the road signs, but that's kind of what I see, and that's an update on global macro.